Hi there. Investing in dividend stocks is an amazing thing. But how do you go about selecting dividend stocks you need to invest in? Is what I'm going to be talking about in this video. Ways you need to go about selecting dividend stocks to ensure you have an optimal constitution in your portfolio. You are all much welcomed. My name is Afagza Sifuna. In case you are new here, kindly subscribe to this channel because I'm dropping amazing videos daily on matters money, and also drop a like on this video. Thank you for subscribing and liking this video. Let's begin. The first criteria you need to look at is buy companies that actually make money. That sounds obvious, but many investors never check it. A company can only pay dividend consistently if it consistently earns a profit, because dividends are basically a company sharing part of the profits with shareholders. If you don't do this, then chances are your hope of even getting dividends is gonna disappear because you didn't do your homework. Imagine two company scenarios. Company A made a profit of 25 billion last year, Kenya shillings, okay? Company B made a profit of 500 million Kenya shillings. Which one is more likely to continue paying dividends? Obviously, company A, because for company B, maybe they need to use that money for paying their operations. They need to use that particular money for example, to cater for their expansion, you name it. And in Kenya, we have amazing companies in the banking sector and other sectors out there, like, for example, EABL, BAT, which have a history of paying dividends and amazing percentages, upwards of somewhere 8% to about 15%. The key lesson here is simple. Before chasing dividends, ask yourself about the profit question. Because if there's no profit, simply walk away. If the company is making losses, the fact is obvious, it won't pay you dividends. The second thing is history of dividend payout matters. Guys, this is the second criteria you need to look at. If a company has paid dividend before, chances are it's going to pay dividends in case it's also profitable. Think about it this way. If someone has paid rent on time for 10 years, will you trust them more than someone, for example, who has only paid once? The answer is, of course, yes. The one who has paid more than 10 years has proven already they can consistently pay rent. So you'll believe they'll pay rent more compared to the person who has only paid once, okay? Even better, what you need to do is to look for companies whose dividends have gradually increased over time. Beyond just paying dividends, have they been increasing over time? For example, many investors favor established dividend-paying companies because they have demonstrated commitment to reward shareholders over many years. Consistency beats excitement. Look at the history and also how dividends have been increasing. And then the third criteria for you is always do not chase high dividend yield only. Case in point, a company can pay 14% dividend for company in stock A, and the stock B can pay 6% dividend. Most beginners will jump automatically to buy stock A because the dividend is 14%. But wait, what if there is a twist to it? Sometimes what we see as percentage yield in dividend could be a reflection of share price crashing, right? Let's use a practical example. Suppose a company used to trade at, for example, 100 shillings, okay? And at 100 shillings, it was paying 8 shillings dividend. That is 8% payout on the dividend, right? Now imagine investors losing confidence and the price drops to 50 shillings. That's 50% of the initial price, which was 100 shillings. If they still pay 8 shillings dividend, the dividend yield is going to be 16%. But then again, is the higher rate always good? In that example I've given you, that 16% encompasses a crash or drop in price of the shares, which of course tells you something is off when it comes to confidence in the market. That's why a higher yield doesn't automatically mean the company is doing very amazing. That's why you need to combine looking at higher yield and also looking at other fundamentals before you make a decision as to whether to jump on a given dividend stock or not, right? And then the fourth criteria you need to utilize is look at dividend growth, not just the dividend yield. This is an important thing. Let's compare two investors. Investor A buys stock paying 5 shillings every year. Investor B buys stocks that are paying 3 shillings every year, okay? It starts to grow, 3, 4, 5, 6, 7, you name it. While the investor in investor A, their stock is at 5 shillings, okay? Who becomes richer after 10 years? Assuming the dividend payout is also commensurate to this particular growth. Who is going to become richer? Of course, investor B, because growing dividends usually mean growing profit, growing business, and growing cash flow. Those are the things you need to look at while you're investing. Growing business, growing profits, growing cash flows. Those are good indicators. And that also is typically reflective in the growth in shares. That's why dividend growth is one of the most powerful wealth building tools you can capitalize on. And then the fifth criteria is healthy payout ratio. Here is another one which investors should know, the payout ratio. Simply put, how much of the profits are paid out as dividends by a company. Suppose company A maybe earns 100 shillings, pay out shareholders 30 shillings. The payout ratio is 30%, okay? That is very healthy. That is amazing. Now let's look at another company, company B, okay? It earns 100 shillings, okay? And then it pays 110 shillings. Can you see the problem there? There is a very big problem. They are paying more than they are earning. That is not sustainable. Or even so, there is a game they are playing in their earnings which you don't know. And that's so because very soon they'll cut dividends. In finance, there's something called taking a big bath when it comes to profit. They could be giving you a signal which they're going to cut very soon because that's the reality. That's why you need to be keen when you are making this decision. What is the payout ratio? Is the payout unsustainable or unrealistic? Run for your dear life. Is the payout reasonable and consistent? Maybe that is a good signal. And then criteria number 6 you need to look at is strong balance sheet. The balance sheet or the bottom line is going to tell you what is happening in the business, okay? Case in point, if company A owes 5 billion, okay, company B owes 150 billion, which of these companies is most likely going to struggle when it comes to paying debt, assuming all the factors are the same? Chances are it's going to be company B. This is information which you can only get by looking at the balance sheet and the income statements. Read the company financials. Because if you don't read the financials, chances are you're going to make a decision based on the sentiments in the market, the hype in the market, hearsay, without you doing your own due diligence. Look at the financial records, annual statements for you to be able to make a decision. Criteria number 7, competitive advantage. This may be the most important criteria for you to capitalize on while you are making a decision to invest in dividend stock. Can competitors of a particular business replace it? Or the business is very powerful? Products people buy every day, okay? Banks with millions of customers. Telecommunication companies with dominant market shares. Utility businesses with a huge number of customers. Those are businesses which have really cemented themselves in the market and they have a stronger competitive advantage than a company which is fickle, okay? Just because maybe the profits look good at this particular point in time, does that particular company have competitive advantage? If it doesn't, if it's not having a strong position, chances are you're going to lose an opportunity of getting dividend and even you're going to lose the opportunity of your share appreciating, okay? And then, once you understood all these things I've mentioned, please note, none of this thing needs to be decided in isolation. You need to make a decision capitalizing on all these criteria I've spoken about because all of them have a role they play at the end of the day in how you're going to be able to gain from your initial investment through the possibility of you getting a dividend and also seeing your stock or share price go up. Guys, which of these criteria have hit home? Is it you looking at the yield, the growth, the payout ratio, or even competitive advantage? Which of these criteria I've spoken about are hitting home? And in case you've been investing in dividend stocks over the years, have you been analyzing them like this, or have you just been investing out there based on market sentiments, the spread of fear, anxiety being done by bloggers out there and newspapers? Or do you sit down, look at the company fundamentals, analyze their financial statements to decide these nuances I've spoken about? I hope going forward, you're going to be doing that for you to be able to make informed decision because, guys, wealth is never built overnight. Wealth is built through consistency and through you implementing the knowledge which you master along the way. I hope and wish you do more keen and calculated investing so that at the end you are able to grow your initial investment. Cheers, guys. Look forward to share with you other amazing videos next time. Take care.